Meanwhile, on that situation where interest rates are going to likely back up some more, maybe a lot more, at least if the Federal Reserve has anything to do about it, it's already created over this course of roughly a month and a half or so, a global bond market rout to the tune of about $2.5 trillion. We have not seen that sort of sinking and swooning since the global financial crisis. In fact, this is bigger than that was back in 2008, remember, carried into 2009. So it's not necessarily a fair comparison, but it does show you how the effect of higher rates, lower bond prices reverberates throughout the economy. So what does Scott Martin do when he advises clients with this phenomenon? They've been pouring their money into stocks of late, which is their hedge, I guess, which is weird. But what do you make of it?
They have been doing that, Neil. The first thing we do is kind of stop freaking out a little bit because it's scary. To your point, my goodness, let's go back in recent history, my friend. You go back to August of last year, August of 2021. The 10-year interest rate, which is kind of the benchmark for a lot of things like Jerry talked about with mortgage rates and so forth, lending rates. Neil, that's doubled since August. Now, that's a funny way to say statistics because it wasn't that high back then, 1.2%, and now we're approaching 2.4. However, you made the key point about wealth management and what we do at Kingsview. I mean, managing assets, asset allocation for clients is challenging right now because stocks and bonds, at least for this first quarter of this year, have been correlating, my friend, meaning they're both going down. So instead of one thing doing one thing and the other doing the other, they're both doing the same thing, which is negative. So you have to start doing some interesting things with portfolio strategy, which includes structured notes, secured loans, gold, things like that, maybe a little crypto if you've got the appetite or the stomach for it, and the Pepto-Bismol handy. But there's things that are going on in the bond market that are scaring people, to your point, because traditional asset class behavior is not holding true to what it's been doing over the last, say, several years.
Now, I guess it depends on the Treasury instrument or note or bond, but the yield curve has been flattening, if not, reversing when it comes to shorter-term rates that are eclipsing rates on longer-term assets. Now, that depends on the rate. I get it, but at the very least, it seems to be, telegraphing a slowdown in the economy. Some say a recession. Where are you on this?
It's telegraphing some bumpy tides ahead for sure, and definitely a slowdown in economic growth, which could be as simple as growth that's maybe 0.5% or 2% versus the 6+ that we've had recently. And you're right about the inverted yield curve. It basically means that there's a risk-off mode on Wall Street, which means that folks don't want to really own much of anything right now, and we've seen that in the performance in Q1 so far. Now, the only thing I would caution folks out there on is that the inverted yield curve, or the flattening yield curve, as you put it, has predicted about 10 of the last 5 recessions, if you know what I mean. So it tends to scare folks a lot, and that's just fun with kind of numbers. But it does show there is a slowdown coming forward, which is why, again, something Jerry mentioned that you and I have talked about before, Neil, I don't think the Fed's going to raise interest rates as much as people think. I think we're only going to get a handful of rate hikes this year, and they're going to see what that does to the economy. They're going to see how inflation kind of materializes here and then decide how they want to proceed forward, but not do the 6 interest rate hikes that seems like everybody's betting on.
I'm just curious what you also make of the comeback in a lot of popular issues, particularly technology stocks. They're not all the way back by any means, and we're still selling off today. But it is noteworthy that technology stocks as a sector and a group are up 14% from their lows. Now, they're still not where they were, but they've clawed their way back measurably. I'm just wondering whether that is an opportunity for investors now to cash out, or to assume that this, rally, or whatever you want to call it, in what is clearly had been a bear market for technology stocks, is over. What do you think?
Depends on your goals, obviously, depends on the time horizon. But I particularly think, and for a lot of our clients, we're seeing this as a major opportunity. I think tech stocks just got thrown out with the bathwater, the baby, and frankly the bathtub because of the fact that nobody wanted to own them. Everybody was afraid of interest rates going up. Yes, Techland has guided down, meaning future earnings reports that we're expecting to receive in the next several quarters are likely to not be as robust as they have been the last couple of years. But let's face it, the last couple of years, Neil, 21 and 20, my goodness, for tech, were pretty much, in a word, awesome. So there has to be a little bit of a pullback in Techland, and we got that. And so therefore, I think tech stocks got to a level where they are very attractive now if you have that 1 to 2 year to 3 year time horizon.
Got it. Scott, great catching up. Thank you, my friend. Scott Martin on all of these developments.
See ya.
Technology.